Becoming a Stock Algorithmic Trader, a Comprehensive Guide. Introduction. Navigating the complex world of stock trading. In today's highly volatile and fast-paced financial markets, traders are constantly seeking ways to gain an edge. Traditional trading, heavily reliant on manual processes and human decision-making, often falls short due to its slower response times and susceptibility to emotional biases. As market dynamics become more complex, the need for more sophisticated trading methods has become increasingly apparent. This is where algorithmic trading steps in as a powerful solution. Algorithmic trading, or algo trading, leverages computer algorithms to automate trading decisions, execution, and risk management. This approach not only increases efficiency but also allows traders to capitalize on fleeting opportunities that may be imperceptible to human traders. Whether you're a seasoned professional looking to enhance your trading strategies or a newcomer intrigued by the world of finance, this video will guide you through the essential steps to becoming a successful algorithmic trader. Understanding the fundamentals of algorithmic trading. Algorithmic trading is more than just automated buying and selling. It's about using mathematical models and statistical analysis to identify trading opportunities and execute orders in milliseconds. The algorithms can range from simple rules-based systems to complex machine learning models that adapt to market changes. Example 1. Moving Average Crossover Strategy. A widely used strategy suitable for retail traders is the moving average crossover. This strategy involves two moving averages, a short-term and a long-term. The algorithm generates buy or sell signals when the short-term moving average crosses above or below the long-term moving average. For example, a common setup might involve a 50-day moving average, short-term, and a 200-day moving average, long-term. A crossover where the 50-day moves above the 200-day is a bullish signal, buy, while a crossover below is a bearish signal, sell. This strategy helps traders identify potential changes in market trends. Example 2. Statistical arbitrage. Statistical arbitrage involves creating algorithms based on statistical methods to exploit the price discrepancies between related financial instruments. For example, a trader might use a pairs trading strategy, where the algorithm identifies pairs of stocks with correlated price movements. When the prices deviate beyond a certain threshold, the algorithm initiates a long position in the underperforming stock and a short position in the outperforming stock, expecting the prices to converge. Problem. Manual trading is often slow, prone to errors, and unable to process large amounts of data swiftly. Solution. By mastering the fundamentals of algorithmic trading, you can automate complex trading strategies, reduce the potential for human error, and respond to market opportunities with lightning speed. Acquiring essential skills and knowledge. To thrive in the world of algorithmic trading, you'll need a solid foundation in several key areas: finance, mathematics, and computer programming. Understanding these disciplines will enable you to design, implement, and refine your trading algorithms effectively. Example 1. Programming skills. Programming is the backbone of algorithmic trading. Python, with its extensive libraries like NumPy, Pandas, and scikit-learn, is particularly popular for data analysis and machine learning applications in trading. For instance, a Python script can be used to analyze historical stock data, apply technical indicators, and simulate different trading strategies. Alternatively, C++ might be chosen for its performance efficiency, especially in high-frequency trading where every millisecond counts. Example 2. Quantitative analysis. Quantitative analysis involves the use of mathematical and statistical techniques to analyze financial data and identify trading opportunities. For example, traders use regression analysis to determine the relationship between stock prices and various factors like earnings reports or economic indicators. Understanding concepts like standard deviation, correlation, and regression is crucial for developing models that can predict future market movements. Problem. A lack of technical skills and market knowledge can hinder your ability to create effective trading algorithms. Solution. Investing time in learning programming languages and quantitative analysis equips you with the tools necessary to build and refine trading strategies that can succeed in various market conditions. Choosing the right trading platform and tools. A crucial step in your journey is selecting the right trading platform and tools. These platforms provide the necessary infrastructure for developing, testing, and executing your trading strategies. The right tools can make the difference between a well-executed strategy and one that fails due to technical limitations. Example 1. Backtesting platforms. Backtesting involves testing your trading algorithms on historical data to evaluate their performance before risking real money. Platforms like QuantConnect, NinjaTrader, MetaTrader provide or Strategy QuantX robust environments for backtesting, allowing traders to see how their strategies would have performed under different market conditions. For instance, you could use these platforms to backtest a moving average crossover strategy over the past decade to assess its profitability and risk. Example 2. Brokerage integration. Integration with brokers such as Interactive Brokers or TD Ameritrade is essential for executing trades in real time. These integrations often come with APIs that allow for seamless communication between your algorithms and the broker's trading platform. This means that once you've validated your strategy through backtesting, you can deploy it in a live environment, executing trades automatically as market conditions meet your predefined criteria. Problem: without proper tools and platforms, traders struggle to develop, test, and implement algorithms effectively. Solution: selecting robust trading platforms and tools ensures that you can develop algorithms efficiently, backtest them thoroughly, and execute trades seamlessly. Developing and testing your trading algorithms. Once equipped with the right skills and tools, the next step is to develop and rigorously test your trading algorithms. This involves creating strategies based on financial theories, market hypotheses, or observed patterns, and then coding these strategies into algorithms. Example 1. Mean reversion strategy. Mean reversion is a popular trading strategy that operates on the assumption that stock prices will revert to their historical mean over time. For example, if a stock's price has significantly deviated from its average, an algorithm might be programmed to buy when the price is below the average, anticipating a rise, and sell when it's above, anticipating a fall. Backtesting this strategy can help determine its effectiveness and adjust parameters to improve profitability. Example 2. Momentum trading. Momentum trading strategies seek to capitalize on the continuation of existing trends. For instance, an algorithm could be designed to identify stocks showing strong upward momentum and initiate buy orders, holding the position until a predetermined momentum loss threshold is met. This strategy is often used in markets where trends are strong and persistent. Problem: inadequate testing can lead to unexpected losses in live trading. Solution: rigorous backtesting and paper trading, testing algorithms in a live market environment without financial risk, are essential to ensure that your strategies are robust and adaptable to real-world conditions. Risk management and continuous improvement. No trading strategy is complete without a robust risk management plan. The financial markets are inherently risky, and even the most well-designed algorithms can encounter unexpected conditions. Effective risk management strategies help protect against significant losses and ensure long-term success. Example 1. Stop-loss mechanisms. A stop-loss mechanism automatically closes a position at a predetermined loss level, protecting the trader from larger losses. For example, an algorithm might be programmed to sell a stock if its price drops 5% below the purchase price. This helps to minimize losses in case the market moves against the trader's position unexpectedly. Example 2. Diversification. Diversification is a fundamental risk management strategy that involves spreading investments across various assets or strategies to reduce exposure to any single risk. For instance, a trader could deploy multiple algorithms that focus on different asset classes, such as stocks, commodities, and currencies, or different trading strategies, like trend following and mean reversion. This diversification can help stabilize returns and reduce the overall risk of the trading portfolio. Problem: poor risk management can lead to catastrophic losses, wiping out profits and capital. Solution: implementing robust risk management techniques, such as setting appropriate stop-loss levels and diversifying trading strategies, is crucial for protecting your investments and ensuring sustainable trading practices. Conclusion: embarking on a career as an algorithmic trader is both challenging and rewarding. It requires a deep understanding of financial markets, strong technical skills, and a disciplined approach to strategy development and risk management. By mastering these components, you can harness the power of technology to automate and optimize your trading strategies, potentially leading to consistent profits and a competitive edge in the market. Start by building a strong foundation in programming and quantitative analysis. Choose the right tools and platforms, and develop a rigorous testing and risk management framework. As you gain experience, continually refine your strategies and stay informed about technological advancements and market changes. With dedication and a strategic approach, you can navigate the complexities of the stock market and become a successful algorithmic trader.